Welcome to This Explainer. Okay, today we are literally tearing down the old rules of wealth management and taking a hard look at the data that's defining our new reality. If you're still relying on traditional strategies to build and, more importantly, protect your capital right now, well, we urgently need to rethink your portfolio. The financial landscape has completely shifted under our feet, and what worked like a charm a decade ago is, frankly, becoming totally obsolete here in 2026.
So you really have to ask yourself, is your 60-40 portfolio actually safe in 2026? I mean, for decades, that standard mix of 60% stocks and 40% bonds was the absolute gold standard, right? It was the go-to for a safe, reliable retirement. But in today's climate of just severe interest rate volatility, the very foundation of that strategy is cracking. We really have to figure out if holding on to this outdated model is actually putting our financial future in serious jeopardy.
Okay, let's dive into this. Here is our roadmap for today. First, we'll cover why traditional portfolios failed. Second, the mechanics of private credit. Third, risk mitigation and diligence. Fourth, strategic portfolio allocation. And finally, number 5, we'll wrap up with your 90-day action plan.
Let's start with Section 1, why traditional portfolios failed.
So recent market turbulence hasn't just dented the classic 60-40 model, it has fundamentally neutralized it. And extreme interest rate volatility is the primary culprit here. Bonds just aren't providing that safe counterbalance to stocks anymore. But there's a second massive issue we're facing right now, and that's S&P 500 concentration risk. A dangerously huge portion of index gains are currently tied up in just a tiny handful of companies. It's incredibly top-heavy. This makes standard index investing far more precarious than it used to be. Because of this, finding true alpha, real market-beating returns, absolutely requires a deliberate shift toward private markets. The public markets just aren't offering that balanced growth anymore.
Moving on to Section 2, the mechanics of private credit.
To really understand where that new alpha is coming from, we need to look at how these funds actually operate as non-bank lenders to mid-market companies to secure those higher interest rates. The 2026 lending landscape is undergoing a massive structural transformation right now. We're seeing a huge shift away from floating rate structures. Instead, the market is currently dominated by highly predictable fixed spreads. And honestly, this is a profound change. For you as an investor, it means stepping away from the anxiety of wildly fluctuating yields and stepping into a landscape defined by reliable, locked-in returns.
Just consider the stark contrast between these two environments. On one hand, public equity markets are defined by high volatility, unpredictable swings, and you're pretty much entirely at the mercy of market sentiment. But on the other hand, private credit loans offer direct legal protections and priority seniority. When these private credit funds act as non-bank lenders, they don't just hand over cash and cross their fingers. They structure these deals with robust legal shields. You're essentially securing higher interest rates while fundamentally upgrading your defensive posture against market chaos. It's a real game changer.
Which brings us to Section 3, risk mitigation and diligence.
Because protecting your portfolio isn't just about chasing higher yield. It's about knowing exactly where you sit in the financial food chain. Let's completely demystify the capital stack for a second. Senior secured debt is the gold standard of safety within this space. It means you have top priority, the loans are backed by actual collateral, and it carries significantly lower risk. Compare that to the mezzanine layers. These are subordinated. That basically means if something goes wrong, the mezzanine layer takes the hit first. It carries higher risk and a very real potential for loss. As an investor, spotting this critical difference is absolutely essential. You want to ensure your money is positioned to senior secured debt whenever humanly possible. Next up, we have to talk about a vital metric for evaluating fund managers: dry powder. This is simply the uninvested capital held in reserve by a fund. So the crucial point is that this cash isn't just sitting idle by accident. It's a strategic war chest that allows a fund to survive market dips or, on the flip side, capitalize immediately on sudden opportunities. When you're doing your diligence, evaluating a manager's dry powder alongside checking their historical default rates during that recent mid-year market dip will tell you pretty much everything you need to know about how resilient they truly are.
Furthermore, you've got to aggressively scrutinize the fine print. You need to demand clear transparency and favorable liquidity terms from any fund you're considering. You need to know exactly how and exactly when you can get your money out. If you don't evaluate these terms carefully, you run the very real risk of having your capital trapped and locked up just when an unexpected market shift requires you to pivot. Nobody wants their money held hostage, right?
Now for Section 4, strategic portfolio allocation.
So now that we understand the mechanics and the diligence required, how do we actually use this to boost monthly cash flow? 10 to 12%.
Let that sink in. That is the projected yield of top-tier credit funds right now. When you compare that 10 to 12% against the stagnating, low single-digit dividends of traditional blue-chip stocks, well, the private credit yield absolutely crushes them. This is exactly the level of monthly cash flow that is drawing so much capital away from the public markets right now.
And this brilliantly illustrates the strategy. To capture those yields, you need a deliberate transition. By carving out a specific recommended percentage of your portfolio from volatile equities and moving it into private credit, you're able to maintain broad diversification while significantly lifting your overall portfolio yield.
But, as they say, it's not just about what you earn, it's about what you keep. To truly maximize your net returns on private debt this year, you need to be highly strategic with your tax planning. You can currently leverage specific 2026 tax advantages designed explicitly for private debt investors. Specifically, utilizing qualified opportunity structures can effectively shield portions of your gains. Honestly, reviewing these structures with your advisor is an absolute must to maximize the bottom line of your private credit allocation. Don't skip that step.
Finally, Section 5, your 90-day action plan.
Look, the best strategy in the world means absolutely nothing without execution. And the good news here is that accessing the best funds is easier now than ever before. Thanks to those regulatory changes in late 2025, digital platforms and interval funds have finally democratized access for non-accredited investors. But wait, before you deploy any capital, you have to use this vital checklist. You must compare management fees, which is what you're paying the funds simply to exist, directly against performance hurdles, which is the specific benchmark the fund must achieve before they're allowed to take a cut of your profits. Doing this simple math ensures that you keep the bulk of the investment gains rather than just enriching the fund manager at your expense.
Let's move to and see how this builds into your 90-day timeline. Step 1. Access the newly available digital platforms and interval funds. Step 2. Rigorously vet those fees versus the performance hurdles. Step 3. Execute your allocation. Remember, you're on a ticking clock here. It's absolutely critical to diversify into private credit before the next scheduled central bank policy adjustment shakes up the interest rate environment all over again. Which leaves us with one final undeniable question to consider. Will you take the necessary steps to restructure your wealth before the next central bank shift? Or will you remain trapped in a failing 60-40 model that is buckling under modern market pressures? The data is crystal clear. The transition to private credit is accessible, and the opportunity is sitting right in front of you. Thank you so much for joining me for this explainer, and I highly encourage you to start your due diligence today.